A misconception that a lot of people have, which is that in order to have safety, you have to have lower returns, no question. And that's actually not true. So, one of the ways that you can sort of prove this to yourself, anyone watching, is you can look at the Dow Gold ratio over time. It's very simple. Just take the Dow Jones index and divide it by the price of gold, and you'll see sort of a sine wave that happens throughout history, throughout the last 100 years or so. And the way you interpret that is that for certain periods of time, the Dow Jones, or stocks, broadly speaking, will outperform gold. And during other intervals, gold will outperform stocks.
Hello and welcome to Wealthion. I'm Maggie Lake, and today I'm joined by Alan Hibbard, co-host of goldsilver.com. Hi, Alan. Thanks for being on.
Hey, Maggie. Thank you so much for having me.
So there has been a lot of headline-driven volatility. How are you thinking about the investment landscape right now? What should investors be focused on, and what seems like just noise to you?
Yeah, great question. It's kind of the eternal question. And it's sort of the one that drives me to build the type of portfolio that I have. So I'm primarily invested in gold, silver, and Bitcoin. And that's a product of basically not wanting to pay attention to too much of the noise that happens at any given time. So right now, there's so much tariff talk with implementations, the possibility of more always. Doge, right? Mass deportations. Obviously, Russia, Ukraine is very tenuous at best. And, there's all kinds of conflicts, all kinds of things that investors could be paying attention to. But for me, the simplest thing is the signal is gold, right? The whole world is driven by fiat currencies. Every government around the world is printing massively for whatever problems they have within their own borders. And the one thing that investors can do is protect their purchasing power by owning gold. That's the absolute bread and butter. It's the absolute basics. That's where I start. And then from there, you can sort of catch your breath and look around and say, okay, now how do I turn 1 ounce of gold into 2 ounces of gold? And that's a loaded question that takes a lot more time and nuance, but that's sort of the high level standpoint that I'm looking at.
So are you, so let's talk about your expectations for your portfolio in that case, because I think that on the surface, a lot of people are going to say, I'm getting really stressed out. I also want to have some sort of peace of mind. I'm looking for that safe haven. But typically when you do that, you're giving up growth, right? And we all still need to try to build our wealth and grow for retirement. That's how so many of us ended up with a pretty large exposure to equities right now. So when you say you're primarily, and we'll talk about that kind of dual, very interesting digital asset side and physical commodity side, but when you're looking at gold, is it because you just want a low volatility, low risk, lower return? Or do you feel like you can have all of those and can capture some of that growth, even if you're in something like gold, which traditionally is a little bit lower returning?
Yeah, that's a great question. And it's a really common one. And I think it sort of points to a misconception that a lot of people have, which is that in order to have safety, you have to have lower returns, no question. And that's actually not true. So one of the ways that you can sort of prove this to yourself, anyone watching, is you can look at the Dow Gold ratio over time. It's very simple. Just take the Dow Jones index and divide it by the price of gold. And you'll see sort of a sine wave that happens throughout history, throughout the last 100 years or so. And the way you interpret that is that for certain periods of time, the Dow Jones, or stocks, broadly speaking, will outperform gold. And during other intervals, gold will outperform stocks. So it is absolutely possible. There are certain periods throughout history where gold performs better than the stock market. And for example, last year, the S&P had a great year. It returned 25%. 25% is fantastic, but gold did 26%. So gold absolutely was not a compromise. And what we've seen the last few years, if you look at any of the three major indices divided by the price of gold, they're all elevated historically based on their long-term average, and they're all trending back down towards the long-term median, the mean reversion. So what that means is that gold is basically outperforming relative to all three major stock indices. And I'm expecting that to continue for the next few years. So it is sort of a misconception that you have to give up growth or appreciation in order to have safety. At certain periods throughout history, you can have both. And we are living through one of those periods right now.
Yeah, which is good because we're living through it right now. But it is a timing issue, isn't it? Because you can sort of be sideways for a while when that gold market is. This is why There are some people that always, or why we're in a situation where a lot of people have historically low exposure to gold because it wasn't sort of giving those returns. So if we're in that period now, are we talking about physical? And we're going to talk a little bit about some of the macro backdrop that might be behind this move that we're seeing right now. But just so people can sort of plug in the right frame of mind, are we talking about physical gold, the commodity gold, or are you talking about exposure to gold, the entire market? So including equities in that, including ETFs in that. What is your preferred expression of owning gold in your portfolio?
Yeah, another great question. Physical. If you can't touch it,
You're going to bite that,
Alan? If you can't touch it, you don't own it, right? Then it's someone else is promising to give it to you when you want it. And sometimes that's okay, right? A lot of times that's okay. That's how our banking system works and our whole equities system and everything. So sometimes that's fine, but sometimes it isn't. And everyone has to make that decision for themselves. But for me, 100% physical. I don't go near the futures or the ETFs or any of the paper gold promises because you might not get that promise when you need it most. So that's kind of where I would start with that. And it's funny you mentioned that because what we're seeing right now in the macro landscape is actually like a mini sort of short squeeze on the bullion banks who have been short gold. And we've seen flows of gold from London to Switzerland to New York to try to cover a lot of those short positions. And we saw a difference in the spreads in the London market versus the New York market. And so there's a lot of signals in the gold market that not everything is as smooth as it normally is. It remains to be seen how it's going to play out. But what it's meant so far is that there are tremendous physical deliveries on the COMEX in New York. And a lot of investors are taking physical delivery. We don't know who those investors are necessarily. It could be the federal government. It could be the Treasury trying to get their gold back into Fort Knox or into the New York Fed or wherever they're supposed to have it. But maybe not, right? We don't have evidence of that specifically. It's sort of just rumors at this point. But that physical gold is so important for any size investor, large or small.
Yeah, I'm so glad you mentioned that because there has been a lot going on in regards to that. I talked to a very long-term gold trader, someone who's followed the market forever, Alyosha on Substack. If you want to go check that out, folks, you can. He gives a real deep dive into this aberration in the market and also what would go into an audit and Fort Knox and all of that, his feelings on that, worth checking out. But do you think, so we don't know a lot of answers, but it is unusual. We've seen this spike in desire to hold physical gold. Does it say something about feelings about risk? Is there something, do we have any indication of why this is happening right now?
Yeah, I think that it varies a little bit based on the investor. So what I would start is I would zoom out and look at the central banks. They're sort of a major indicator of where the rest of the world moves. And if you look at central banks and what their attitude has been towards gold over the last few decades, they've been net sellers of gold from the 1980s to the 1990s and to the 2000s. They've been net sellers of gold. The price of gold has gone down and the whole world sort of turned to equities, right? The 80s and 90s leading up to the dot-com bust was huge for stocks. I mean, that was the place to be. However, that all changed around 2014, 2015. Central banks became net buyers of gold. So they've been accumulating gold. And you kind of have to ask yourself, why do central banks own gold? Like, why bother? It's just a rock. Well, it's not just a rock. It's actually a store of value. And it's the best store of value that the world has had for thousands of years. And so central banks do that to protect their own purchasing power and to protect the financial stability of their system. And it also improves confidence as a result. And confidence is critical to the fiat game. So that's why central banks are buying gold. And we also see a lot of geopolitical tensions with war and peace and trade wars, proxy wars, regime changes all over, assassination attempts. It's a very shaky situation in the world right now. And so you have a lot of other investors, institutional investors, even retail investors who are sort of saying, okay, I don't know how the world is going to play out. I don't know what countries are going to exist, what leaders are going to exist, what their policies are going to be. I don't know what I'm necessarily going to need for myself or my family. I don't know if I can stay in my own country in a lot of cases. I may have to flee. And so I think a lot of investors are thinking, okay, how do I protect everything? How do I move from a risk on environment into a risk off environment? And that just means gold pretty much wherever you are in the world. Gold is like a really great starting point. And otherwise, circumstances may vary. You might go into something else as well.
So, in terms of the economic backdrop, we have a lot of concerns about prices, what's happening with prices. Uh, given the fact that we, may have some rolling impacts from tariffs, but certainly there are other factors that have been influencing prices. Inflation has been moving down, but we're at this point now where there seems to be some division. What are you looking at from a macroeconomic backdrop that makes you think that gold is also the place to be in this environment?
Yeah. So one of the things is sort of a capital rotation event. So capital has been in equities as it normally is. Most of the time capital flows into equities, but we're seeing it sort of rotate out of equities into gold. That's sort of what I talked about with the Dow gold ratio, S&P gold ratio, NASDAQ gold ratio. And each of those ratios is above its long-term average, but is moving back down. So I expect mean reversion and a continuation. So that's a really important starting point for looking at the macro landscape. Another one is interest rates, looking at real interest rates. So, for example, if you take the Fed funds rate and subtract the CPI, you get the real interest rate. And this is extremely important because it affects the incentives on where people can get a return on their investment. So, whether they go into bonds or gold, which has no yield, or something like equities or real estate. And so, what we find is that throughout history, there's been two long periods of negative real rates. One was the 1970s, and the other is roughly the year 2000 until today, so roughly 25 years. Those are really the two periods we've seen in the United States, at least, where we've had sustained long-term negative real rates. And what happened during both of those periods? Well, those are the two bull markets that gold has had. So I'm expecting the bull market in gold to continue as long as we have negative real rates. And that is one of the critical macro indicators, right? Negative real rates, or maybe they move positive at some point. But as long as they remain negative, I'm expecting the bull market in gold to continue.
So if we the period if we were to see, and there's a lot of division about bonds, right? Where do rates go? And there are many who believe that they're moving lower, that the Trump administration wants to see lower rates. That's where their focus is. So that's what's going to happen. But there are plenty of other people who believe this is a populist agenda. Around the world, populism is on the rise. We are in a higher inflation environment. Debt loads are increasing, so you're going to see upward pressure on yields regardless of what governments want. The bond market will do the talking, and you're going to see elevated yields. In an elevated yield situation, if that scenario were to play out, is that competition for gold? If you're getting paid to hold either cash or treasuries or a government bond, wherever you may be sitting, but for most people listening to this, it's going to be treasuries. Is that a consideration? Is it gold versus bonds type of decision?
Yeah, for a lot of people, it might be gold versus bonds. However, the 1970s is a fantastic case because it sort of disproves a little bit of conventional wisdom. And a lot of times we say, okay, if interest rates go up, that's bearish for gold, right? People aren't going to want to hold gold because it's just so much more attractive to hold a treasury or some other bond. And that's true in the short term. But what's interesting is in the long term, you look at the 1970s, the Fed funds rate went up to 22%. 22%, that's unheard of. 22%. And that was the end of gold's bull market. Gold doubled in a year, doubled in price in a year. And that was in 1979. So it's not necessarily the case that gold can't perform well in a high interest rate environment. It absolutely can, and it has. And I'm expecting that to continue because the setup we had in the 1970s, high inflation, which caused high interest rates, and then the high inflation also caused high gold prices. That's exactly what we have now. The reason that we're going to get high interest rates, in my opinion, is because of all that debt and inflation that you talked about. But that debt and the inflation is the same thing that's going to drive the price of gold higher. So the setup is very similar to the 1970s. I think it's up, up, up in terms of debt, inflation, interest rates, and the price of gold. It's all going to go up.
So what's your price target on gold? We saw it hit some record highs. It's backed off that. I mean, what are we looking at in terms of upside?
Well, if you're going to give a price, don't give a date. If you're going to give a date, don't give a price. So I do expect gold to do really well this year. So last year, by the way, 2024, that was probably the last time you could buy gold under $2,000 an ounce. There was a time in January, February, you could get it in the 1900s. Now we're up in the 2900s, flirting with 3000. And I think this year is going to be the last year you can get it under 3000. I think we're going to clear that benchmark and never look back. And maybe next year we might be talking about 4,000. I'm not sure, but we are talking about some pretty big moves and sustained moves. So I think gold has a lot of room to grow. And as we look at something like the Dow Gold ratio, up around 15 right now, the long-term average is about 8. But it doesn't just move to the median and stop. It moves to the median and carries through to the other side and then swings back. So I'm expecting that ratio to move to about 1 or 2. So we might expect gold to outperform the Dow by a factor of 6 or 7 or 8 in the coming years. So I don't know what that means in terms of a dollar price, but it just means that gold is looking to me far more attractive than equities for the next few years. And then switch back into a risk-on environment. Buy all the stocks when there's blood in the streets, but that's not today.
Yeah, I've been having this conversation over and over because for so many years we've been programmed to buy the dips, and so there's a really robust conversation. And it's really important for people to stop and take the time to think about this with a little bit of a longer lens, because there is so much change going on. And do you need to also rethink the way you're considering allocation? Many people are saying we're kind of in a different regime right now. So it's really important to look at that. I think it's worth touching on supply, because we've been talking so much about, the environment, the macro environment. But is it still a case that, as with so many commodities, that you may have people, there may be more demand because people are looking to put more into their portfolio as a way to have a safe haven or as a way to protect against the things you just spoke about? What's the supply response timeline in the market? Are we still looking at years to get gold online, or could we see producers ramp up if we see the type of demand you're describing?
Yeah, well, when it comes to producing gold, silver, any of these metals, you can't just flip a switch and turn it on. It does take years to get these mines operational and get them producing any kind of meaningful output. So these mines do respond to price, of course. So in order for some of these mines to turn on and activate, they do need to see higher prices. It's that simple. So as the price of gold comes up, more mine supply will come online, but it will take a few years, to your point. So it's not exactly an overnight thing. And in the case of the silver market, silver has been in a deficit, a structural deficit, for 5 years now. So the demand for silver has outstripped the supply 5 years in a row. So in order to meet the demand, we have to go through existing stockpiles that are already above ground. So I think in the case of gold, the new supply coming online is not too much of a concern for the next couple of years. It's more of a conversation that we could have down the road.
So it's very interesting to me, given the scenario that you just laid out, that you're also looking at Bitcoin, because it would seem that it would be exactly the type of volatile market that you're trying to avoid, and yet you also have that in your portfolio. Explain that to me.
Yeah, well, I'm not scared of the volatility. So if I were a retiree, or maybe just in some other circumstances, the volatility might be highly, highly relevant, and Bitcoin might be the last thing in my portfolio. So I totally understand that for people. But I'm a young guy. I don't plan on retiring for some number of decades. So if it's volatile in the meantime, that doesn't bother me in the slightest. I've been in Bitcoin for 10 years. The volatility used to bother me. It doesn't anymore. So I'm happy to have it in my portfolio. And that's exactly the important thing, is to think about it as a portfolio. So, any one particular asset can look scary in terms of volatility, but if you have 2% of it, 5% of it, some smaller percent of it in your portfolio, and you just look on a portfolio basis, you might not even notice the volatility. So, I would encourage investors to think about what Bitcoin is and what it isn't fundamentally. And then as a secondary concern, look at the technicals, look at the volatility, and sort of ask yourself, okay, what is the role of this in my portfolio? What volatility am I comfortable with? What kind of timeline is important to me? And what happens if I'm wrong? Like, what kind of insurance
What's
against
the fallout? How much can I afford to lose? Right? That's
exactly. Yes.
But so what? How do you define Bitcoin? Because this is very important. Some people just see it as another expression of the Nasdaq, as a high momentum, high vol, high risk asset that allows you to capture a lot of alpha, but there's a huge amount of risk that goes along with it. But for other people, it's something completely different. So what role does it play in? It sounds like it's your exposure to risk and volatility, but how is that true? And how do you define it?
I think about Bitcoin as digital gold. I really do. I think of it as a store of value. So when I think of my portfolio, including gold, silver, and Bitcoin, I think of it as three forms of money. And as a result, that almost makes me a saver and not an investor. So I'm not taking any centralized risks. There's no companies in my portfolio. There's really no countries in my portfolio. I don't have jurisdiction risk. I don't have management risk, counterparty risk, none of that. Because I think we're going through a period where a lot of seemingly trustworthy, reliable companies or institutions or systems are going to prove to be unreliable. They're going to do surprising things to people. And I don't know specifically what those are, but I'm just I'm a very risk averse person, believe it or not, even though I do have Bitcoin in my portfolio. I play it safe. So it took me a long time, many years to study what Bitcoin is. I do think about it as digital gold. And I don't think of it as risk on. I think of it as a tremendously asymmetrical bet. I think that Bitcoin will prove itself to be a better form of money than gold, right? For 5,000 years, gold hasn't really had a competitor. I think now it does. And so there's a question among investors or among savers of which money are you betting on, right? Which money do you think is a better form of money? And everyone has to pick. And you can pick more than one if you put different allocations in your portfolio, but everyone has to make that decision. And if you neglect making that decision, if you don't have any gold, any silver, any Bitcoin, if you're just denominating your portfolio in dollars, you're going to have a really hard time because dollars are absolutely not money. We know they're going to go to zero eventually. So you're kind of flirting with disaster. You're kind of betting on yourself to get the timing right when it's important. And one thing I've learned from trading is it's really hard for me to get the timing right. So I like to take these long-term views. I like to be very patient, invest for 10, 20, 30 years. Because when I try to invest for a month or two at a time, I get it wrong so much.
Yeah.
And so if anyone's just sitting on stocks and bonds or a portfolio like that, you're betting on yourself to get the timing right. And what if you're wrong? Like, what if you're wrong and you don't sell at the right moment? It just seems dangerous to me.
That's such an interesting way to put it. And so interesting. And I'm so glad that you put the age lens on it because I think that's very important. So when you're talking long term, I mean, you're talking minimum 10 years, but with a pretty high probability, it could be longer than that to see this play off. Is that fair?
Oh, absolutely. Yeah. I'm looking at it as a long-term investment. Because I mean, even something like gold with thousands of years history, if you bought in 1980 and waited 20 years, I mean, you were down 70%. 70 in gold. So it lost 70% of its value in 20 years. That doesn't sound like a store of value. And that's because it came off, an unbelievable bull market and so forth. So even with gold, you have to think about 30, 40, 50 years, just in case you get the timing wrong. And certainly with Bitcoin, I would put it in the same category. So yeah, I'm thinking in terms of decades, no question.
So do you in the way you think about portfolio construction, do you not have any exposure to assets that will capture return in a shorter time period? Is your entire timeline long on your portfolio?
Yes, right now it is. That is my entire portfolio. I used to have two different IRAs. I had, the S&P, I had a bond fund, I had a few different things, and I sold them few years ago. And I took, a 30% penalty, a 10% penalty. I paid dearly to get out of those positions, and I put it into gold, silver, and Bitcoin. And the reason I did that is simply because, like I said, I didn't want to bet on getting the timing right. I didn't want to try to call the top in the stock market or the bond market.
Mhm.
I just wanted to get out of any type of counterparty risk or centralized management risk. I didn't want to log into my brokerage account one day and then the website's down and I can't make a trade. And meanwhile, the markets are crashing because that happens, right? When the markets move a lot, there's a huge demand to access websites and the servers crash. And it's not necessarily a malicious thing. It just happens that way. We see the same thing with crypto wallets. When everyone's trying to buy Bitcoin and Ethereum in the same day, sometimes those exchanges go down just simply because of, denial of service attacks or just the sheer volume. So yeah, I got out of all those investments that might capture little premia in the short term. And I'm just long term right now until things stabilize. Maybe 10 years from now or 5 years from now, my portfolio might begin to switch the other way. I'm very excited for that, by the way, because it's boring just sitting in gold, silver, and Bitcoin. I want to have companies. I want to have dividends. I want to have products and services I'm excited about. But right
Yeah.
now, I'm mostly on the sidelines.
Well, I appreciate you being so honest about that, and I think this is really interesting. So a couple of the things that are surfacing as we're having this conversation is, and I did not know what was in your portfolio before we had this, so this is kind of real time discovery. But I think it's important to understand why you're investing too, and you just gave us a really good framework of where your mind is and the things you are concerned about, and have made a decision that you would rather have a boring portfolio than one that exposes you to risks that you feel like you're going to lose sleep over. So not only what should I put my money in, but why? When do I need it? What's my time frame? Why am I doing that? I mean, these I think are the kinds of conversations that are really important to have with your financial advisor and with yourself, right? Honestly, with yourself, so you can think about making these decisions. And this is not going to be a portfolio for people who have a shorter time horizon maybe, or need to grow their wealth a little bit more for something that's sort of 5 years ahead of them or something. But these are the kinds of conversations, like the tone of the conversation that you want to have. So I think that's so fascinating. Are you in any other crypto? Since you understand it, it's so interesting to me because it's more complicated, and everyone should take the time to understand what's going on there. The financial innovation happening is super interesting, but you haven't dipped your toe into any other projects that.
Well, I've dipped my toes into other projects, and maybe my foot and my ankle, and they got cut off. So I will admit I throughout the years I've bought probably a dozen altcoins, other crypto projects. And I like to think that I did my due diligence far more than the average investor. I actually drove 5 hours in a snowstorm to meet with a crypto team, meet them personally, look at their code. I did my due diligence. I mean, how many investors can say that?
Mm,
And I, invested a sizable amount. And within something like 2 years, that investment lost 99.9%.
mm,
So I put in $20,000 and it was worth $20, 20,000 to 20. And that was not because it was a scam. That was because one of the members of the founding team had a family member who had a health problem, had a ton of medical debt. It wasn't covered by insurance. And he sold a ton of that coin in order to pay for it. It tanked the markets. Nobody knew what was happening and it never recovered. And
wow.
so it wasn't necessarily malicious. It wasn't a scam. This is just one thing of many that could go wrong with these coins. Everything has to be perfect. You have to have the perfect coin with the perfect name, the perfect marketing, the perfect team, the perfect execution, the perfect legal jurisdiction, the perfect everything. And you have to not be perceived as a pump and dump scam that's
Mhm.
endorsed by the wrong celebrity or the wrong whatever. Of these tens of thousands of coins, they're all centralized, which makes them kind of like companies, except when you buy one of these tokens, it's not a share of the company's profits like a stock is. It's just a coin. So imagine instead of investing in, a share of Chuck E. Cheese, you're just buying the tokens that people put in the machine, hoping that the tokens become more valuable. That seems very dangerous to me. So if you love Chuck E. Cheese and you want to play all their games, great, stock up on tokens. So like if you really love doing smart contracts and you want to perform them and use them with your friends or your business, great, buy all these tokens that are great at smart contracts. But if you're just trying to make a profit, if you're trying to buy low and sell high, it is such a dangerous game to play. I do not recommend it for anybody. I think Bitcoin is in a league of its own. Everything else is like you really shouldn't go near it unless you're using the token for what it's meant to be used for. Not trying to buy low, sell high. Don't do that.
I think that's really, really timely advice given the fact that we are also having a national conversation potentially about some kind of crypto reserve. We don't know, very skinny on details. It may not even be happening by the time anyone's listening to this. But again, there's a lot of temptation to jump in. We've seen that. We saw the big moves and then it fell all the way back. So you say that we are in a period where nation states are beginning Bitcoin, the Bitcoin accumulation game has begun on a national level?
Mhm. Yeah, absolutely. So, yeah, before I talk about that Bitcoin thing, let me just comment on the other coins. So I think Trump is mentioning those coins because they're companies that were founded in America. And in my opinion, that's a pretty lame reason to use taxpayer money to buy those coins. for a lot of the reasons I just said. I mean, execution has to be great. I mean, the average American does not need to do a smart contract for any reason,
Mm.
and shouldn't be speculating on the price. So that's dubious. Um, Even in the case of Bitcoin, it's such a young asset, and I'm a huge Bitcoiner, have been for a decade. I love it. I recommend people learn about it, but it's a little weird to me to spend taxpayer money on accumulating Bitcoin when there are so many Americans who don't understand what it is and who are like viciously opposed to it. There's many that really, really think Bitcoin is a scam. They don't want to go anywhere near it. So I think before we do that as a country, there needs to be some education campaign around it. I would really appreciate that, right? As an American, I would appreciate if Trump and whoever demonstrated that they understood what Bitcoin is, if they understood what these other assets are, and helped the American people to understand it as well, and then move forward to buy it. But yes, to your point, I
That's a
do.
great point. I just want to say that's an excellent point. And listen, the crypto industry itself, legitimate folks who are really innovating and building in the crypto community have been saying all along that transparency is what's needed. It's what they want. It's what they're working toward. So it would be, if there were to be a plan to move forward, that would be such a critical component of it to have the public trust it would need. I think that's a really, really important point.
Yeah, absolutely. I think the public trust is a huge stepping stone. I do believe, in general, the new administration is going to have much more transparency than previous administrations, which is great if that ends up being the case. But it's certainly in the case of Bitcoin, there is a massive knowledge gap and trust gap, and I would like to see both of those filled a little bit before we move forward with actually buying the coin, with taxpayer money.
This is
However,
early stage, right? This is
yeah.
like early seed, the kind of thing that we don't usually see. Companies, if you're a venture investor, companies go out of business all the time. There are failures all the time before you hit the unicorn. So this is not unusual. It's just, it's in a space that so few understand, I think.
Yeah, exactly. But to the point you mentioned earlier, I do think that the game theory is playing out, right? The nation state level adoption game theory is happening, whether we like it or not. So it's a little bit of race, but it's also a delicate balancing act with what we said, balancing public trust and so forth. But the incentives are such that early on, when Bitcoin was like $1, $10, obviously a nation state can't buy that. It doesn't make any sense. The entire market cap is maybe less than $1 million of a coin. It doesn't make any sense. But as it gets larger, different types of investors can start to look at it and start to understand what it is. And it goes from individuals to eventually companies. We saw MicroStrategy sort of pioneer that. And then it moves to countries, and El Salvador sort of is groundbreaking, but there's a handful of other countries that are either mining Bitcoin or buying it with public funds. So we've got the UAE, Argentina, Bhutan, of course El Salvador, and there's another one
Most
I'm
of them are
forgetting.
shut out of the trend. They have no choice because they're shut out of the traditional financial system for one reason or another.
Exactly. And so again, this is the game theory, right? If you're a smaller country with, the lowest GDP in the world, you can risk it, right? You can afford that kind of a risk because there's nowhere to go. There's nowhere to go but up. So,
Mm.
you can't go, if you're already in last place, you can't get any worse, kind of a thing. And if you're shut out of the US financial system, that incentivizes you to go to an alternative like a Bitcoin. But like the strong, stable countries like a US and a China don't really have an incentive to just go head over heels into Bitcoin until they start seeing the other one signal and do it, and then they'll dip their toes in and sort of accumulate over time. But we're going to see those smaller countries go in. Many of them probably already have and just haven't made it public because they're probably continuing to accumulate. But then we'll get the medium countries, and eventually we get the big ones. And once a big country goes into Bitcoin publicly and says, we're buying a bunch of Bitcoin, every other country pretty much has to do it as well. It's sort of because that's sort of an acknowledgement that Bitcoin is like gold, right? So many countries hold gold. And it's sort of like the longer you wait, the higher price you're going to have to pay to take your position. So it is a race. It is going to happen, whether we fill that education gap and the public trust gap or not. It does seem inevitable to me.
Yeah. And in the meantime, again, as you pointed out, this is a long-term view, and this is still a very risky asset if people are considering it. So you have to take that into account. We'll finish up with gold. And um, do you think, and this question, which has been kicking around, do you think the US is going to revalue its gold? Is that on your radar?
I love this question. I think about it all the time. I've been thinking about it for years. And, do I think they will? That's one question. And
Do you think they should?
do I think they should is another. Do I think they should? No. Because here's what would happen if they do. If they revalue it to like the market price, let's say $3,000.
We should just stop and say this is taking all of the holdings of the US gold and marking it to market in today's prices. I think it's calculated at something like $41 or something crazy
42
like
and 2/9. 42 and 2/9 dollars. So 42.22. And that's the book value. And so it's about $11 billion worth of gold. And 11 billion sounds like a lot, but you mark that to market and it's not quite 100 times that, but it's
you
still
get
a
the
lot.
idea.
Anyways, so call it $1 trillion, let's say. Here's what would happen. That would give the Treasury, or they could instruct the Fed to credit their account with a similar amount, like put $1 trillion into the Treasury, and then they could spend it on whatever. That sounds great, but there are other ramifications. One of which is anyone who doesn't own gold in the United States would be sort of impoverished immediately. And the reason that would happen is because the government can't really say what gold is worth. They can't really say what gold is worth. They can't say what the price of gold is in Japan or in Brazil or in the United States. They can't do that. What they can do is they can say what the dollar is worth. And so revaluing gold to a higher level, in practice, what it really is it's saying the dollar is not worth what everyone thinks it is.
It's a massive devaluation of the US dollar.
Devaluing the dollar, and in this case, going from 42 to something like 3,000, or let's just say 42 to 4,200, right? A factor of 100. If they were to do that, that would say like that dollar you're carrying around in your pocket, it's only worth 1% of what you think it is. Mm-hmm. So if there's like a loaf of bread that costs $1, it becomes $100 in the grocery store. Like the prices would go up by the same factor, whatever the revaluation factor is. And that would impoverish most Americans overnight. But, if we're going to look at the bright side, but the government has $1 trillion that they could use to spend on whatever, social programs, paying down the debt. But is that worth it? I don't think so. It's not even close. Oh my goodness. No. Not
well,
even
you can
close.
imagine what the reaction would be.
Yeah. And then there would be a ripple effect into absolutely everything. Businesses. I mean, oh my God, you can't even imagine how bad it would get. But just understanding that the government can't really say what gold is worth. They can only say what the dollar is worth measured in gold. When you realize that, it's like, oh, should we destroy the value of the dollar? No, we should not, because it would impoverish everybody. So I really hope that Trump, Elon, whoever's around him, I hope they understand that, because I don't think it's a good idea at all.
And I think that's a great way to put it, because if you hear people talking about it, it's probably because they are a proponent of it. And that's exactly why they're talking about revaluing the gold, because it looks like we get a lot of money for that. They're not talking about the negative side effects as much. So it's a really, really good distinction. This has been fantastic. It's so great to have you on. So great to have this conversation with you. Thank you so much.
Thank you, Maggie. It's been wonderful.
Appreciate it. And we'll see you all again soon.